There are easy mistakes to make to assume that a data center is a data center is a data center, a fiber network is a fiber network. As an investor that specializes in this space, our job is to be more nuanced than that, right? To understand the critical distinctions that can make the difference between a profitable investment or one that's going to struggle.
Hello and welcome to Cool Vector. I'm David Snow, your host. And today we're joined by Mark Prybutok. He's a managing director at GI Partners. GI Partners, of course, is very well known for investing in the digital infrastructure sector, as well as in private equity and real estate strategies. We're going to learn how those strategies fit together and give GI Partners an advantage. But Mark, thanks so much for joining Cool Vector today, and I look forward to delving into your knowledge about what's going on in the world of data centers and digital infrastructure.
Yeah, it's my pleasure, David. It's great to be with you.
I would imagine that a few years ago, when you were at a backyard barbecue or a dinner party and you told people that you invested in data centers, maybe they didn't quite understand what you were talking about. Maybe they didn't register a spark of recognition. But I would imagine now people are quite enthused to hear about what you invest in, given the high profile of data centers. Can you talk about sort of the change in awareness?
Yeah, definitely more popular at cocktail parties. When it comes to infrastructure investing, as you mentioned, GI Partners has been over the past 25 years investing in and around this space, going all the way back to 2001. The first investment the firm made was actually in a portfolio of data centers coming out of the dotcom crash, and that we turned into Digital Realty Trust. In terms of infrastructure investment appetite in particular, really 2016, 2017, 2018, we started to see more and more infrastructure funds embracing the concept of digital infrastructure as a real component of an infrastructure portfolio. And it's interesting, even today I have conversations often with managers of portfolios, pension funds or sovereign wealth funds or insurance companies, and they'll say, gosh, we allocate 20% to digital, and we're surprised to see our managers at that level or ahead of that level. My response is, well, why shouldn't it be higher? If you think about infrastructure as the physical underpinnings of the economy, and you think about what drives the economy, 6 companies, right? Apple, Alphabet, Amazon, Meta, Microsoft, NVIDIA, that right there is like 30% of the S&P 500, market capitalization, right? If you think about what's driving growth in the stock market, those 6 companies probably more than 50%, easily more than 50% over the past couple of years. So I would say, why shouldn't it be significantly higher than 20%, 25%? This is the 21st century economy. Digital infrastructure should be a reflection of what drives that economy.
Well, as you've seen more and more investment firms get into digital infrastructure, what have you noticed that impresses you, and are there any aspects of it that worry you?
Yeah, what impresses me is that realization that this is the critical foundation of the economy. So that is something that just about everybody in the infrastructure world now appreciates. That's great for us as a specialist investor. Greater understanding and greater adoption of that broad context is only helpful. The thing that worries me always is, particularly when new investors are coming into a space and diving in head first, is, people don't know what they don't know. And this is very typical. It's not unique to digital infrastructure, certainly. There are easy mistakes to make to assume that a data center is a data center is a data center, a fiber network is a fiber network. As an investor that specializes in this space, our job is to be more nuanced than that, right? To understand the critical distinctions that can make the difference between a profitable investment or one that's going to struggle.
Let's talk about the specific way that GI Partners approaches the digital infrastructure opportunity. You invest in operating businesses, which of course is different than in buying flat dirt and then building a data center on top of that. Talk about why it's important to draw a distinction between the more private equity oriented way that GI Partners invest in the space versus perhaps some other approaches.
It's not to say that there's a right way or a wrong way. Obviously, folks can be very successful investing purely in real estate development. Our approach of investing in operating businesses is really about sticking to our knitting. The heritage of GI is built off of a private equity investing platform. And so that's what we know, and that's what we know how to do well, is to take going concern businesses with management teams, support them, help them layer in appropriate process and systems, add additional people to drive growth. And so we do that across our private equity platforms in software businesses and healthcare businesses. And we can adopt those exact same playbooks to data center businesses, fiber businesses, wireless access businesses to drive growth through those same types of platforms in the digital infrastructure space.
Since you invest across data centers, data transport, wireless access, tech-enabled infrastructure, what would you say are the commonalities of business characteristics that those four asset types have?
What we like are businesses that have stable, recurring revenue, highly sticky customer relationships demonstrated over a long period of time, businesses that are technology enhancing rather than technology exposed, and we can talk a little bit about what that means. And those common threads apply across all four of the pillars of our data infrastructure investing strategy. When we think about the four categories, data centers, data transport, wireless access, and tech-enabled, what we're really talking about is an ecosystem. And if you think about any one of those four, they really don't exist without the others. Take tech-enabled infrastructure. These are networks of connected devices. So maybe the connected device could be a gas meter or a power meter at your home. That meter is connected back to a network through a wireless connection, right, to a tower. That tower is aggregating all the meters from your neighborhood, and then a fiber network is delivering that back to a data center where all that information aggregated from your neighborhood and all the surrounding neighborhoods in your town or region, that data is pooled and analyzed. And now the utility can make certain decisions about how to manage its grid. And so there you have all four of those segments operating in concert. And so we really think about the importance of data infrastructure as an overall system. And therefore we allocate our sort of investment strategy across those four. Investment in one informs us about the opportunity to invest in the others.
What to you are the most important megatrends taking place in and around the space that affect GI Partners' investment strategy?
What drives our investment strategy is a mega trend of digitization, which is many, many decades long. The digitization of just about every process you can think of in terms of how we conduct our business and how we lead our personal lives. We are very much still in the early days of AI adoption for business functions. We're starting to see a shift from AI training, which was the big focus and kind of a buzzword that everybody's been focused on for the past couple of years, to AI inference, which is essentially taking these trained models, putting them out into the wild where they can impact business decision-making and real-time functionalities. So that's an important trend. The interaction between AI and the Internet of Things, so these networks of connected devices where we're collecting data in real time and then using AI, both generative AI, like a ChatGPT, for instance, as well as machine learning and computer vision to drive that real-time instantaneous decision-making is revolutionary. And that's driving tremendous opportunity as well and tremendous need for incremental infrastructure across the entire landscape.
As more and more investors have become interested and become active in the digital infrastructure space, that means, I presume, that more and more of them are showing up at auctions and in sort of competitive processes to buy some of these companies and some of these assets. How does GI Partners avoid sort of getting stuck in that scrum of bidders and distinguishing yourself as a buyer of digital infrastructure businesses?
We think about ourselves along really three core principles. Okay, one is just intense sector focus, and that gives us the ability to be highly thematic. So when we look at any one sector, we're not looking at data centers or fiber networks. We're really diving deep, and we're focusing on particular regions, particular use cases, right? Is there a particular industry that this business is serving? We're doing a lot of work around nuance, right? What drives relative value between one company in this space versus another? How are these companies positioned for maximum growth? And then where can we bring operational value add? And so if we are thinking about the world in that way, and we're identifying businesses that we in particular think are going to be the winners within a subsector of a subsector, we're not afraid to participate in auctions. Sometimes you have to, right? I mean, it's certainly our investors for any business that we own. They want us to make sure there's competitive tension when it comes time for us to exit. But we also want to be a half step ahead of where the broader infrastructure universe is playing and is focused. We're really thinking about where is the space going, what's next, right? And then within the things that we think are the highest potential, how do we maximize our opportunities to identify the best businesses, develop the relationships that put us in the best positions, and then have the understanding, the market knowledge to drive the best growth.
Without giving away any secret sauce, are you spending a lot more time in a certain type of sector, looking at certain types of businesses, given what's going on in the broader ecosystem?
Well, we see opportunities across all four of our target subsectors. I think one theme that is very interesting is the idea of infrastructure at the edge, the evolution of thinking from AI training, right? Massive data center campuses, which are centralized locations where these AI models can be trained. Now we take those trained models and put them out closer to those end use cases. There's a massive opportunity, multiples larger in aggregate than your massive concentrated AI training data centers, but located closer to those end use points. That evolution is really a nice fit for us for what we do, where we're focused on businesses that are, number one, mid-market businesses. So from a size perspective, it makes a lot more sense for us to be investing around businesses that own and operate assets of a more moderate scale relative to these massive hyperscale facilities. And number two, offer greater opportunities for value add. So businesses where the customer base is not Amazon, Microsoft, Google, NVIDIA, these businesses that are massively capitalized, incredibly cash rich, but businesses where IT is actually not their core competency, right? So if you think about a hospital system, you think about a regional bank, an insurance company, a university, for them, IT is absolutely critical, but it's not their core competency. And so if you have a more diverse base of customers where IT isn't what they do all day, every day, you can offer them traditional access to your infrastructure, right? In the case of a data center, we're talking about space and power, but they also want products and services on top of that physical infrastructure. And that's a great opportunity for us to drive value add, right? To provide those services, to have a deeper relationship with those customers. And those are the things that really excite us because they lend themselves to our focus on operational business, operational investing. Generally, we're looking at businesses that have been operating for years. They've got track records, they've got customer relationships, they're profitable. Oftentimes where we get interested, and there's a good synergy between ourselves and an existing owner of a business, is when you've got a company that's hitting an inflection point, right? They've demonstrated, they've proved out that business model. Now they need more capital to get to the next level. So even though an edge data center is many times smaller than a hyperscale AI training or public cloud, focused data center, these are still highly capital intensive. There's a cash need, a need for growth equity oftentimes that comes along with these opportunities. But there's also a need for greater sophistication. So when a company hits $10 million, $20 million, $30 million of EBITDA, right, it goes from 50 to $100 million of revenue, let's say. Now you're talking about orders of magnitude in terms of decision-making apparatus within a company. You're talking about the complexities of operating across multiple geographies, the need for systems upgrades to support a much larger base of customers or customers that are taking multiple products from you. And that's where we like to come in and where we can offer something to those businesses to help them get past that plateau, that inflection point onto the next level.
Mark, earlier you mentioned that there's not one right way to invest in digital infrastructure, but a very prominent form of partnership taking place are huge mega campuses being built with hyperscaler customers in mind. Do you think there's a risk of overconcentration of customers among hyperscalers and that some of these mega campuses being built might not have the kind of stability that their underwriters think they do?
I think the risk is not so much around the customers. When you think about who those customers are, and you more or less count them on the fingers of one hand, these are the best capitalized businesses in basically the history of the world. It's less about the quality of those customer relationships. I think where we're a little bit sanguine is where we see people investing in data center development that is many, many years out into the future. And constraints right now, in particular, with respect to supply of energy that may be resolved in 5 to 7 years or even longer in some cases, you need to be careful, thoughtful about the way that markets may develop in that period of time. It may not seem like a long time in the context of traditional infrastructure investing, but if you think about just where we've been over the past 2 years in AI, right? 2 years ago, we had the first major public announcement, ChatGPT, boom, we're off to the races. A couple months ago, the announcement of DeepSeek. So now we're talking 10, 20 times greater efficiency. Just in a 2-year window, we see these kind of pretty significant forces. If you're making plans that are reliant on predictive market conditions that are 7 years into the future, you want to be somewhat conservative there.
Mark, I'm glad you mentioned DeepSeek. What do you think the impact of DeepSeek will be on different segments within the digital infrastructure value chain? Clearly, it will have an impact on chip makers, and it'll also have an impact probably on data centers, but it's probably not the same. So can you break down what you think the differences are?
Yeah, that's exactly right. And when we hear news like this, we really have to be thoughtful going from the macro. What does this mean in terms of overall technology adoption? And when we saw that DeepSeek news, of course, the public markets did kind of a whipsaw. There was a moment of panic that we saw reflected in stock prices. And then there was a response. And that response was, well, Jevons paradox tells us that with greater efficiency will come greater demand, and that demand will ultimately swamp the efficiency gains such that overall demand will increase and overall need will increase. And that's true, we think, for the NVIDIAs of the world, right? For the Microsofts of the world. What that means for an owner of a particular data center in a particular location may be different. It's important to have a bit of caution when we're talking particularly around investments that are very tailored to a particular use case in a particular place. And one thing that we see, for instance, even from hyperscalers, while you can do AI training anywhere, in the middle of nowhere, let's say, why do we see more of these massive hyperscale campuses being developed near Northern Virginia, near Dallas? The reason is that it's important for those end users, those hyperscalers, to have flexibility in use case. The idea that something is going to be purpose-built for AI training that may not even be developed for 7 years into the future in a location that's entirely remote, that may be a great value proposition, but you want to make sure it's well thought out.
Talk about the fact that GI Partners seeks to avoid technology risk. What does that mean generally for your firm's culture of investing? And then can you apply that specifically to data centers?
We think about the idea of infrastructure that's technology enhancing rather than technology exposed. And so what do we mean by that? Infrastructure at its heart, we're really talking about steel and concrete, or if you're talking about fiber networks, it's glass, fibers. Underlying infrastructure supports technology needs as they evolve over time. And we can see this historically in cell towers. We've gone from 2G to 3G to 4G to 5G. Those same towers retain and actually increase in value over time because the technology that sits on the physical infrastructure is actually that much more powerful and that much more critical to everything we do in our daily lives. That is a technology enhancing piece of infrastructure. We want to avoid investments that are highly technology exposed, either businesses that are investing in homegrown technologies where developments by a competitor or evolutions in technology could make a particular product or piece of infrastructure obsolete, or where we're making massive investments in technologies that are themselves rapidly evolving. right? And so if we think about in the data center context, there is massive investment, for instance, in businesses that provide GPU as a service. The rate of evolution, the pace of improvement in that chip technology is stunning. As an infrastructure investor, you want to make sure you're not getting stuck investing in a generation of technology that is then, made obsolete by improvements that happen in the next generation of technology. Because sometimes we do see these leaps. There's potential there for an infrastructure investor that becomes, maybe unwittingly, a technology investor to become exposed to those evolutions. And so we do a lot of thinking at GI about how to make sure we are technology enhancing rather than technology exposed.
As you are trying to get a read on how technology is evolving such that it applies to your business model, what indications do you follow most closely? What kind of news from the tech world do you pay most attention to?
My joke response is the number of news clippings that my mother sends me is my indicator. But seriously, what we've really liked to see is clear evidence of adoption of these technologies for business purpose. So when we talk about, again, going back to AI, tons of news about ChatGPT, great. How are businesses deploying it? And what do those deployments look like? And what are the actual business cases that are identified and funded and driving return on investment?
Have you observed a particular business function where it's clear that this is going the way of AI?
Absolutely. I talked earlier about the interaction between AI and machine learning and computer vision. We see real world examples of businesses that rely on video feeds and the review of video feeds to drive decision making, whether that's public safety oriented industrial applications, where the number of people reviewing and responding to alerts is going down exponentially as the AI improves and those businesses can take advantage and realize those efficiencies. It's real validation that this technology put out into the world, inference models, can drive massive improvements in efficiency. And in that, we see, number one, greater profitability and efficiency opportunities for existing businesses, but also the development of new business models. So if you have a business case that relies on detecting anomalies, think about widgets going across an assembly line, and there's a tolerance of one mistake per million widgets. You could never monitor that with individuals. But if you're leveraging AI to identify those faults when you see them, and then make decisions on how do I address that fault if I identify a pattern of those, now you've got something where you're leveraging data in real time to drive a potentially impactful outcome.
GI Partners invests in private equity strategy, real estate strategy, and digital infrastructure. What advantages does your firm get by having those three different businesses under the same roof?
It's really the cross-pollination of ideas and sharing of experiences. GI from its earliest days has been investing in businesses that touch data infrastructure and touch technology. The opportunity to sit across from colleagues who are investing in software businesses or healthcare IT businesses and understand how those companies are leveraging data infrastructure in their day-to-day operations makes us smarter. Likewise, in the real estate side of things, understanding the dynamics of supply and demand, in particular in the data center space, at an asset level within a given market is very valuable to us as we think about making investments in data center businesses or fiber businesses that are serving a particular region, because we see where that demand reflected in real time, pricing in those markets.
Back to your point about how you are now sort of the sought after conversation at dinner parties because you're involved in data centers. What makes you excited looking forward at the opportunity ahead of you to be an investor in the digital infrastructure space?
It's an exciting time to be investing in this space. The pace of change, the pace of development in terms of how, again, AI is impacting businesses across the entire spectrum of industries creates a wealth of opportunities for us. The investing world really understands that data infrastructure is a critical component of the overall infrastructure landscape and a growing one. The need for specialist knowledge and focus in the space is one that we think the market is really wrapping their arms around.
Mark Prybutok from GI Partners, thank you so much for talking to Cool Vector today, and I hope that we can have you back in the future to help us understand what's going on in the world of digital infrastructure.
It's been fun, David. Thank you.